Welcome to this month's Market Update. I'm here with Casey Lowe, Senior Consultant and member of Frontier's Capital Markets and Asset Allocation team. Hi there, Casey.
Hi.
Now I can see that you're underway in your annual Movember campaign, Casey. Tell us a little bit about that to get started today.
Yes, as you can see, the progress has been a bit slow, but it's progressing.
Getting there.
So I'm doing the Movember again, just doing my bit for men's health.
Excellent. Hope you can all contribute to that. So there's a lot happening globally at the moment, but let's focus today domestically, and in particular the Reserve Bank, their recent shift on the cash rate.
Yes, so the Reserve Bank of Australia increased the cash rate by 0.25% at the latest meeting. So the cash rate is now at 2.85%, which is quite extraordinary when you think back. They only started to increase the cash rate back in May, so about 6 months ago. And since then, they've increased the cash rate by 2.75%, so significant increase there. But at their most recent meeting, they've also updated their economic forecast. In particular, they've increased their outlook on inflation. So now they expect the inflation to peak at around 8% later this year. So up marginally from what they previously expected. But also they expect inflation to stay elevated for a period of time. So they don't expect, they expect inflation to stay above 4% even through the whole next year. So inflation will stay high for a while. So that has meant that market expectations have shifted, increasing a bit more. So the market now expects the cash rate to peak at around 4% in the latter half of next year. But so, quite a few things are happening on the inflation front and the cash rate front. But the governor of the Reserve Bank of Australia, it's also worth mentioning that he spoke about how, in terms of the future path of the cash rate, that they'll be willing to do larger hikes again if needed, if inflation stays very high, but also that they'll be willing to take a pause in the cash rate if it's needed as well. So it just goes to show that even with all these economic forecasts that the Reserve Bank of Australia has, that the current environment is highly uncertain in the economy and that they're willing to shift whichever way depending on economic outcomes.
So of course the most obvious effect of the cash rate is its impact on mortgage repayments, but it flows through to many other areas. One of those is currency. Talk to us a little bit about the impact on currency, Casey.
Yes, that's right. So the cash rate is quite a blunt instrument and it really impacts everything in the economy, but the main one really is on the mortgage side, but it also impacts foreign currency, as you mentioned. So Australian dollar is an interesting one just because it has moved around quite a bit over the year. So if you think back to the start of the calendar year, it was at about 71 cents. And currently it's bouncing between 62 to 64 cents against the US dollar. So it's fallen materially since the start of the year. But it's not so much that the Australian dollar has been weak, but it's more so that the US dollar has been strong against most other currencies. So in fact, if you look at the Australian dollar against other major currencies, for example, like the British pound, the euro, the Japanese yen, we've actually done pretty well against those currencies. So if you're looking for ideas for overseas holiday destination, those are a few there.
Thank you, Casey, covering all bases today. But what are the implications for investors around those movements in currency?
So we think about foreign currency in a few ways when it comes to investment portfolios. The first one is that the Australian dollar provides downside protection, or I should say foreign currency provides downside protection for Australian investors. What I mean by that is during periods of market stress, the Australian dollar tends to fall, which is what we've seen over the last few months, where volatility in equity markets, the Australian dollar has fallen as a result of that. So what that means is that as the Australian dollar falls, the value of your foreign investments increases, offsetting any negative impact from performance. So to put it in another way, a dollar of a US investment at the start of the year, or I should say right now, is worth more than where it was at the start of the year. So there's that downside protection element of having foreign currency, which you probably would like to have more of right now, just given the volatility in the market. But the other perspective is from a valuation side of things. And we look at a few models for this, but one of the key ones is the purchasing power parity model, which is about the long-term value of our currency. To explain that in a bit more detail, the purchasing power parity model, the PPP model, is all about equalizing the price of goods between different countries. So for example, if the price of McDonald's Big Mac is worth $2 here in Australia, it costs $1 in the US, then over the long term, you expect the currency exchange rate to equalize at around 50 cents to equalize the two prices there. So based on that model itself, it suggests that the Australian dollar currently is looking quite undervalued. So there's some support there for the Australian dollar to increase in value over the long term.
Excellent. Based on your $2 example, it could be a while since you bought a Big Mac, Casey, but nonetheless, good to know you're across the other factors. And thanks for joining us on this month's Market Update.